Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of LME 3-month nickel, zinc and tin.
LME 3-month nickel. The most significant feature of this market in recent weeks has been, and still is, the very significant lows of 2021 at 15,665, which led to the lows of late November 23, plus this year in January, February, and with some mild finessing the lows of late July and early September in the 15,840 and 15,600 zone. At this point, I feel obliged once again to mention the big descending scallop pattern I've been going on now for months now, and what it may mean within the near-term universe. So the key level has been and is the lows at 15,840. A significant move below this, and by that I mean you would know it when you see it, a significant break move below this would give a potential downside for the descending scallop pattern in the 13,830 zone. It still all comes down to what the market has done, and even might still do, with the 15,840 zone. First time around in late July, prices chose to bounce back upwards, and during the start of August sustained the bounce. However, over mid-August, prices had an issue with testing the June 2021 low at 17,095. And I suspect indirectly the now flatlining long moving average, currently at 17,370. The suspicion eventually evolved into a mid-July to early September ascending wedge pattern. Then, early 9 weeks ago, prices broke down through the base of the ascending wedge pattern, easily reaching the primary target and close enough to the secondary target for me to choose not to designate it. However, the market then built up again, enough for me to finally draw a late July to mid-September bullish Andrews pitchfork, which held with some minor breaches until 2 weeks ago, when prices punched down through the lower time, currently at 16,840, and the nearby May 2021 low at 16,610. Below this was a fairly free area until we once again reached that key level, the 15,840 level, last week. As I said 2 weeks ago about such a move down, and I quote, "This move lower, should it continue, will bring to the fore once again the question I posed right at the beginning of this commentary, and I have done now for months, the future of the big descending scallop pattern." End of quote. As I've said earlier, and many times before, a significant move below this, and by that I mean you would know it when you see it. A significant break below this would give a potential downside target for the descending scallop in the 13,830 zone, and I can't keep emphasizing that. Emphasizing that. Well, so far, after last week's venture down there, prices have initially pulled back up away, and today seemingly are trying to stabilize just above that key 15,840 zone. But it's not so far above as to not threaten that zone below, so just keep a careful eye on it. LME 3-month zinc. This is a very busy and colourful chart. For that I apologise, but all these patterns here do relate to what is going on right now, so let me explain. 10 weeks ago, prices drove higher, prompted by a small late July to mid-August reverse head and shoulders pattern. Up over the June 2021 low at 28.10, over the broken old upper time, currently at 28.57, of the May to August 2023 bullish shift pitchfork that subsequently acted as a August 23 to April 24 upper bull channel line. Then over the green short medium moving average, currently at 29.86, the medium moving average, currently 29.05, a congestion band between 29.58 to 29.65 containing the April high at 29.59 and the 50% Fibonacci line of the big old 2008-2022 move at 29.65, plus further up the green middle time, currently at 30.63, of the February to August bullish shift pitchfork, as well as over the July high at 30.22, followed by the purple neckline extension of the September to December 2022 reverse head and shoulders pattern, currently at 31.37, where the market finally slowed down and took a breather 3 weeks ago, just shy of the June 2018 high. I said on this move up 4 weeks ago, and I quote, "Prices have moved higher still to now test what I suppose is the holy grail of this market, the purple neckline of the September-December 2022 reverse head and shoulders pattern. This could become a seminal moment, so watch carefully." End of quote. I also said 7 weeks ago, and I quote, I've also drawn a new early August to early September bullish Andrews pitchfork, highlighted in bright red in a renewed hope to showing the bullish angle of attack of this market, end of quote. Well, this bright red bullish pitchfork had been operational until 3 weeks ago, when the market turned lower and breached the bright red lower time, currently at 32.28. For a while, though breached on the downside, the market also did not let go of this bright red pitchfork. I suspected it was due to the mid-October seeing not just the bright red lower tine and the purple neckline extension, but also the green middle tine, currently at 30.63, the February to August bullish shift pitchfork, and the dark blue neckline of the small late July to mid-August reverse head and shoulders pattern, currently at 31.47. All of these together in a fairly narrow range that helped hold the market up. However, these four, they're now separating. As a consequence, their combined forces, which were greater than each individually, is now coming under bearish pressure. And I will likely retire by next week the bright red pitchfork and even downgrade the dark blue neckline, as they are far enough away from the market to deserve such treatment. This all went back to what I said 4 weeks ago, and I quote, the question now is whether the market will falter here, much as it did in late May, or will it really go for the higher price? End of quote. Over the last 4 weeks, I had hoped to see, if not the answer, then the beginnings of the answer. Last week, this still eluded me, but the beginnings of a possible tempting of the green short-medium moving average and the congestion zone below between 29.58 to 29.65. Well, it is now looking as if it may be on the cards. I would not suggest any more than that. I'm just saying it might be on the cards, as mid-October is littered with attempts lower that failed. I'd continue to do what I suggested last week, and I quote, keep a careful watch on the 29.40 zone below and what may or may not happen at and over the purple neckline above, end of quote. LME 3-month tin. Prices started their recent build higher between mid-July to mid-August, down at the congestion between 28.835 to 29.005, containing the July 2011 high at 29.005, plus the important gold highlighted slowly rising long moving average, currently 30.735. And back then, the nearby neckline extension for the October 23 to January 24 reverse head and shoulders bottom, currently at 28.465. And finally, the 50% Fibonacci line of the March 23 to April 24 move, down at the 27.330. All these slowed, stopped, and at the start of August, turned prices higher. The pushback up then became stuck in what I can best describe as an accidental congestion area overhead, created by a combination of the medium moving average, currently at 31.930, the short medium moving average, currently 32.030, the 50% Fibonacci line of the March 20 to March 22 move at 31.845, plus the neckline of the thin and tall April base head and shoulder pattern, yes, that one, currently at 31.950. Prices were stuck there, more or less, until 7 weeks ago, when they broke higher, moving up over an earlier all-time high from April 2011 at 33.610, and up to the 50% Fibonacci on the March to October 22 move up at 34.175. This was breached, but the market could not sustain the break any higher. 7 weeks ago, I drew a late July to early September bullish Andrews pitchfork, which I finessed 3 weeks ago into a shallower bullish shift pitchfork for the same move. So it's from an Andrews pitchfork to a shift pitchfork for the same move, and which is highlighted in dark blue on my daily chart. Now, I was the first to admit that this was a very imperfect pitchfork, but market still utilized it until 3 weeks ago, when prices punched down through the lower time, currently at 32.110. But only as far as the gold highlighted slowly rising long moving average, the same one the market had bounced up from in late July, then early August, and also avoided in early September. I said 2 weeks ago about this long moving average, and I quote, this is a key level, and it asks the question of this market whether it will bounce up from it as it did in late July and early August, as well as to a certain extent back in early September, or will it break it and test the late July base congestion between roughly 28,835 to 29,005. There's a lot of overhang in this market, so if it does break, then it may reach down to the previously mentioned neckline extension for the October 23 to January 24 reverse head and shoulders bottom. However, we have not done so yet, so just watch carefully in case it does. End of quote. Since that time, the market has been shadowing the gold long moving average below until late last week, when prices pushed back higher and started testing overhead. Testing that previously mentioned accidental congestion zone, made up from the mauve medium moving average, the green short medium moving average, the 50% Fibonacci line at 31,845, and the thin head and shoulders neckline, which I've today highlighted in bright red, currently at 31,950. Prices today have travelled higher still over the broken dark blue lower time, currently at 32,110, though as yet the market has not stabilised up in this area and may be susceptible to a retreat back down. What this has done is at the least delay my retiring the dark blue bullish shift pitch hook and wonder if, just possibly, if the market is trying to repair the damage done to the lower time over the last 3 weeks. If the market does not repair this break low, then as I said last week, and I quote, I'd continue watching carefully as there is another very recent pattern possibly developing, and that is the action over last week and the start of this week. It could be the flag part of a possible bear flag. If this comes about, and the true break below the gold long moving average will seemingly justify such a break, well, the downside could be measured anywhere between 29,500 down to 29,000 or even 28,250. End of quote. Watch carefully, as we'll soon know if this break happens or if we are sustained above the dark blue lower time, the broken lower time.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.